FTX, Celsius, Voyager, 3 crypto exchanges that all went bankrupt. The question many users have is, when will I get my money back, if I get any at all? Today, we delve deep into this issue to bring you insights on the bankruptcy process, user reimbursements, and potential tax implications. When a company such as FTX or individuals file for bankruptcy, it's a formal acknowledgement of their inability to meet financial obligations. We all know that FTX declared bankruptcy back in November of last year due to SBF's fumbling of user funds. Let me brief you on bankruptcy proceedings very quickly. In bankruptcy proceedings, the order in which creditors are paid is determined by the priority of their claims. Typically, secured creditors are paid first, as their claims are backed by specific collateral. Unsecured creditors are paid afterwards and are further categorized into priority and non-priority claims. The last to be paid out are usually the non-priority unsecured creditors. These can include suppliers, customers, and credit card suppliers. And if there's any remaining value after these creditors are paid, equity holders, such as stockholders in a corporation, are the last in line to receive anything from the bankruptcy estate. In this situation, customers are being paid out last. You probably aren't getting your full amount back either. Why is user reimbursement typically less than the total amount owed? The liquidation of assets might not generate enough to cover every debt, especially after deducting administrative and legal fees. Reimbursements often fall short of the total owed, meaning users might only get a fraction of their assets. After the assets are distributed, the bankruptcy concludes with a discharge, absolving the debtor from the remaining unsecured debts. While this offers some relief to users, it also underscores the importance in diversifying assets and researching platforms thoroughly. Some users have already started receiving funds back.
George, looks like your FTX payout came in.
Oh, finally. Heck yeah. What the?
Jokes aside, here's what an actual check will look like. Shout out to Ashley Decan for letting us use the photo of the check she got. As a tax lawyer, let me break down some potential tax liabilities with payouts. If what you received is only the amount you initially invested, you might not owe additional taxes on it. However, if there's an extra amount, perhaps from trading profits or bonuses, you'll likely need to pay tax on it. And if you sell any crypto received at a value higher than when it's worth when you got it, you might also have a capital gains tax. On the other hand, if you didn't retrieve your full amount, you could claim a loss, beneficial at tax time. Keeping comprehensive records from the received value to subsequent trades is paramount. And given the intricate nature of crypto taxation, always consult with a certified tax professional about your specific situation. What if I didn't receive anything at all? Can I claim those losses on my taxes? This is by far one of the most popular questions I get when exchanges go bankrupt. In the United States, if you experience financial loss due to unfortunate events such as fraud, theft, or bankruptcy of a crypto exchange, you may have the option to claim these as deductions on your income tax return. However, the process is governed by specific rules. To begin with, you must substantiate your losses by providing comprehensive documentation, including records of your original investment, transaction history, and any announcements from the exchange about its insolvency. The nature of your loss plays a crucial role in how it is treated for tax purposes. Losses from investments in crypto assets are treated as capital assets that can be considered capital losses. These losses can offset capital gains, and if the losses exceed the gains, up to $3,000 can be used to reduce ordinary income each year, with the remaining losses carried forward to any future years. On the other hand, if your loss is due to theft, such as hack of an exchange, it may be deductible as a casualty or theft loss. However, following the Tax Cuts and Jobs Act of 2017, personal casualty and theft losses are only deductible when they are connected to a federally declared disaster. It's worth noting that the amount deductible is generally confined to the actual capital you invested, not including any potential profits or market gains that were unrealized. Have any more questions about exchange payouts? Make sure to comment below. And if you found this video enlightening, please give it a thumbs up and subscribe for more financial and crypto insights.